Time now for a little bit of a history lesson, because during the Depression, the Glass-Steagall Act was introduced to split up banks and brokers. 10 years ago today, that act was repealed, a move that some now blame for the financial collapse. Our markets desk is exploring that story. We're going to start with John Erlichman on the repeal of the Glass-Steagall Act.
Well, and obviously we talk so much about the creation of financial supermarkets like Citigroup, but one of the other effects, Scarlett, was for existing Wall Street firms, this need, if you will, to compete with the banks and those massive deposit bases, feeling like, wow, we've got to get big balance sheets.
We've got to get in on this.
And as a result, what is very clear is the trend in things that show leverage, like assets to equity, which is a way to see how much debt is financing your firm. From, say, 2000 to 2007, in many cases with the brokers, you saw these climb. Morgan Stanley is a great example of that. It was around 21.5 in 2000. You go to the end of 2007, it's at around 33 plus. Now, we know that in 2008, that story changed. Morgan Stanley's watching its risk levels, but this is the kind of stuff that those who are concerned about that repeal and are arguing for, what do you call it, a repeal of the repeal?
Right.
Like Paul Volcker, they're concerned about the leverage story. It could all happen again. That's their concern.
Now, Morgan Stanley, a broker all along, although it did merge with Dean Witter at some point. What about Robert Rubin's role in this? Because he later on became a high-paying member of Citigroup's board.
Those always point to that, yeah, and always asking the question of what exactly Rubin's role was at Citigroup, why he was playing that role after the fact. You're right. Certainly, Sandy Weil was the gentleman who went to Washington, very pushed for this, and obviously we've seen what happened in the Citigroup's case.